Do you remember the three statistics we've been working with in the past few episodes? That 90% of all businesses fail within 10 years, and that the economic cycle in our country usually lasts about 10 years, and that 90% of all business owners don't know how to read or don't read their financial statements. Warren Buffett says that the language of business is accounting. Now remember, for a guy like me, that was not very good news because I did not know the language of accounting. So I figured out pretty early on that I had better learn the language of accounting, and it is a weird language indeed. Hello, my name's Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Self-Storage Quick Start Academy. And I support small investors who want to get in the self-storage business or who want to grow their self-storage business in a strategic way that creates true wealth and a fulfilling career. And I love self-storage, but I was working with other people's money, and I figured out I had better learn this weird, bizarre language of accounting. So much of what I've shared over the past few episodes, I've learned from Keith Cunningham. If you want to go deeper into the subject, for people like us without a background in accounting, it is a great resource. But what I learned was there were three scorecards. If accounting is the language of business, business is a game. The accountants are the scorekeepers, and the scorekeepers have three scorecards. And if we can learn to read these three scorecards, we will be able to have the numbers tell us a story. So if you haven't seen any of the past three episodes, I invite you to stop now, go back starting with episode 115 and watch them, because today I want to talk about the third scorecard. And if you remember, the first two scorecards are theories. Scorecard number one, now scorekeepers call it a balance sheet. Really what it is, it's a snapshot at the end of a period of time of your company. It's a snapshot of numbers. And the second scorecard, what the accountants call the P&L or the income statement, the one that all us business owners love to look at, that is a movie of the transactions that happened in that time period, and some of those numbers on scorecard 2 or on scorecard 1. But I assert that scorecard 1 and scorecard 2 for the most part are theories. They're not real. It's not a fact. Why? Well, because scorecard 2 measures profits. You cannot spend profits. Try to pay your light bill with your profits. Try to pay your property taxes with retained earnings. You can't do it. You can only pay bills with cash. And the third scorecard is the scorecard of cash. The scorekeepers call it a cash flow statement usually. Now here's the weird thing. I have never had an accountant hand me scorecard number 3. I have always had to go hunting it up myself. No accountants ever handed me that card. Maybe they can deduce the cash, the one fact that's the most important, how much money do we have, from looking at scorecard 1 and 2, but I sure can't. So it turns out that there's three types of cash. So if you're looking at scorecard 3, you're going to see three types of cash. Operating cash is made from the operations of your business. So in other words, the renting of units, the selling retail items, selling truck rental. And you can earn operating cash two ways. You can earn it by somebody handing you money, a check or a credit card, or they can give you an IOU, saying they'll pay it later. The IOU, the scorekeepers call accounts receivable or AR. And you can spend operating cash by paying your bills or giving a vendor of yours an IOU. and the scorekeepers call that accounts payable. So you earn by getting money or accounts receivable. You pay operating cash out and spend it by writing checks and paying bills, or accounts payable. The second type of cash is investment cash. Now, investment cash can be made in any time period by selling off some of your things and stuff. Some of the things and stuff that are on scorecard number 1. You can sell a piece of real estate. You can sell a piece of equipment, and that would generate investment cash. Or you can spend investment cash by buying a piece of real estate, buying a piece of equipment, and paying for it. Specifically on scorecard number 1, the scorekeepers call that PP&E, property, plant, and equipment. And then the last type of cash is investment cash. Now, you can make investment cash by getting a loan from a bank or bringing in money from investors. And you can spend investment cash by paying the bank back or paying the investors back. When you pay the investors back, the scorekeepers call that a dividend. So scorecard number 3 measures all 3 types of cash, and it looks like this. You start with the beginning cash, then the operating cash that you made or spent, investment cash you made or spent, and the financing cash you made or spent. Now, this could be any time period. This could be a month. This could be a year. It could be a quarter. But then scorecard number 3 ends with the ending cash. Now, scorecard number 3 is a movie. It's a movie about how the transactions in that month or that year affected your cash, not your profits. See, here's the thing. Scorekeepers really are not that concerned about your cash. They're concerned about your profits because they spend most of their time thinking about taxes. Taxes are paid on profits. We're business owners. We spend most of our time thinking about cash. Now, don't you think that scorecard 3 would be an important scorecard to get? They've never given it to me. Yes, it's important to be able to know your profits and design a tax strategy. But I'm telling you, cash is the most important thing because without it, your business fails. Now, it turns out not all cash is equal. What cash do you think is better than all the other types of cash? Yeah, that's right, operating cash. Operating cash is the most important cash that there is. Here's the thing, if your operating cash is not increasing, your business won't last. Sure, there may be time periods, short time periods, or bursts of where your company's growing and your operating cash might not be growing as fast or growing like it should, but those should be very small time periods. For the most part, your operating cash should be growing, because if it isn't growing, that tells you that you're paying your bills with either financing cash or investment cash, and that is an unsustainable business model. In fact, if your operating cash isn't growing, you can either pay your bills by dipping into your savings, you can pay your bills by selling something off so you can generate money to pay bills, or you can borrow the money, either raise it from investors or go to a bank. Those are the 3 options for paying your bills when you don't have enough operating cash. If that happens long enough, you're out of business. Now, people have done some real funny things around these scorecards. Now, who do you think are the smartest people in the world when it comes to financial matters and the language of business? Who do you think it would be? Wouldn't you think it would be the financial advisors in the Wall Street gang that's their entire job is to look at businesses? Well, let me show you how not looking at all 3 scorecards, let me show you the impact that can have as an investor and as a business owner. So let's look at a company. Now, this is a publicly traded company, Yes, it probably has an extra zero or two more than the typical self-storage facility, but let's take a look at a particular company. And I want to look in the period from 1999 through 2001. Now I want to show you an example of what can be done with funny scorekeeping. Now, if you haven't noticed, I'm off the subject of self-storage. I'm standing on a soapbox, and just let me rant, because very few people will ever listen to me. Maybe you will, but let me rant. Here's what I know. Never give your money to the financially smart people. If you've got to invest in anything besides self-storage or real estate, something you know about, my suggestion is put it in index funds. Let me give you an example. Look at this company. So what you'll see is the net income from Scorecard 2 and put on Scorecard 1. Remember the number that we all love to look at. You can see in 1999 was $887 million. 2000 went to $899 million. Then in the first quarter of 2001, it went to $405 million and then bounced back up to $788 million. Now the cash, remember, the scorekeepers think that cash is part of your things and stuff. In 1999, on scorecard number 1, that scorecard showed $288 million worth of cash. Then in 2000, it went to $1,374 million. First quarter of 2001, it was $1,086 million. And in second quarter, it dropped down to $847 million. Now, earnings per share. Now, I know in self-storage we typically don't have earnings per share, but that's the value of the company. In 1999, it was $1.10 per share. In 2000, $1.12. First quarter, 92 cents. Into the second quarter, 61 cents. Now, what can you see from looking at these numbers? Is this a company you would buy? If this was a self-storage facility, would you buy this self-storage facility? Well, I don't know. Let's look and see what the smartest people on the planet, the smartest financial minds said. So let's look and see what the brightest minds, the sharpest minds in the financial world had to say about this company. So, March 12. Lehman Brothers said it's a strong buy at $61.27 a share. March 21st, Bear Stearns, near-term buy at $55.89. Now remember, the high had been $1.10 in 1999. Later on in March, Goldman Sachs recommended this company at $55.31 a share. In June, Bear Stearns said it's attractive at $51.15 a share. The smartest, brightest minds in the financial world, the people we give our money to. J.P. Morgan, in June 15th, said buy it, $47.26 a share. In August 15, it was a strong buy, according to the Bank of America, $40.25 a share. Early September, Sandra Norris said you ought to buy this at $30.49 a share. A.G. Elton, when it hit $33.10 in October, said you ought to buy it. Later on that week, First Albany said this is a strong buy at $31.73. Not to be outdone, Merrill Lynch said this is a long-term buy when it hit $31.39 a share. And later on that month, J.P. Morgan said, yes, it is a long-term buy, $16.41 a share. So I guess, it's on sale or something. Finally, on October 25th, Bank of America said this is a market perform, which means we don't know. We don't know which way it's going to go. If it goes up, it's going with the market. If it goes down, it's going with the market. So Bank of America didn't know when it hit $16.35 a share. And later on, in a couple weeks, on November 1, Merrill Lynch, they became neutral on it at $11.99 a share. And Goldman Sachs, later on that month, when it hit 61 cents a share, said, you ought to hold on buying this. And finally, it hit zero. And earlier that month, on December 2nd, Enron, the company we've been looking at, filed bankruptcy. Smartest minds on the planet. Company went from $1.10 per share all the way down to zero. Look at the rest of the story. So remember the net income. Let's look at scorecard 3. 1999 operating cash, $1,228,000,000. 2000, $1,779,000,000. First quarter 01, this company was able to turn $405 million of profit into $464 million of operating cash. And look how well they did second quarter. $788 million of profits was turned into $337 million of operating cash. Let's look at the investment cash. Remember, that's selling your things and stuff. Investment cash, $3,507,000,099, $4,264,000,000 in 2000, $1.1 billion and $1.1 billion in second quarter 2001. And let's look at their financing cash. Remember, this is money borrowed or raised from investors. $2.4 billion in 99, $571 million in 2000, $1.3 billion first quarter 2001, almost $2 billion second quarter 2001. So if anybody had actually been looking, they could see that cash from operations was going down and they were paying their bills by borrowing money or selling stuff off. So let me just give you a hot tip. If your self-storage company looks like this, you're in trouble. If you're having to pay your bills with investment or financing cash for long periods of time, you're in trouble. As you saw, this company was Enron, and you know how many people lost by listening to the financially smart people? You know how much retirement money was lost by listening to financially smart people? Learn the language of accounting, learn to translate this language, and use it. Don't rely on the financially smart people. This is your business. You're responsible for your success. Learn how to translate this weird language of accounting into something that makes sense for you so the stories can begin to stand out from the page. Now, this was an extreme example, but I'm telling you it happens every day. And as you start looking at storage facilities to buy, and you start looking at your own self-storage business, as you begin to translate this weird language, all of a sudden, what to do begins to jump off the page at you. And what we're going to do next week is tie it all together, tie all three scorecards together, and I'm going to share with you 3 rules that I have learned about operating cash and running a self-storage business. So thank you very much for letting me rant. My name's Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Storage World Analyzer. It's a financial analysis tool that we use every day to analyze self-storage projects as we look at them and decide whether we want to make a run or try to buy them or try to build them, and what we can pay for them. Very powerful tool, most powerful tool we use. So thank you very much, and I look forward to being with you again soon. You can find out more creating wealth through self-storage and thestorageworldanalyzer.com. See you later.